if you have too much money in your IRAs or a very large IRA account, you might have a tax problem here, folks. So there are 3 solutions on how to reduce your taxes with your IRA, whether it's for yourself or for your estate and your kids or beneficiaries in the future. Now, the last one we're going to talk about, the third option, is going to be unique, right? So definitely stay to the end as we go through this here, because that last thing we go over probably be different than what you've ever heard before around planning around IRAs. But we'll go over the first option here. If you have a very large IRA account, you can look at Roth conversions. You might have heard of this before, right? If you haven't, it's the process of taking an IRA and actually moving it over to a Roth account. You pay taxes today, all right? And when you move this over to a Roth, it's going to grow tax-free going forward. Now, where this makes sense and where you should probably think maybe a Roth conversion is good for you is if right now you are in a lower tax bracket. Okay, so if you're in a tax bracket today, like for like the 12% or even 22%, and you feel like maybe in the future, because of your RMDs or other taxable events that happen, you might be going into higher tax brackets, it might be a good idea to do a Roth conversion. Also, conversely, if you're in the 12% tax bracket and you're not going to use your IRA, maybe you have a pension today or other accounts you're going to utilize, and your kids who are going to be probably inheriting this money down the road, they're in a higher tax bracket than you, like they're in the 24% tax bracket, well, then it might make sense for you to pay the tax of the 12. This way your kids don't inherit this IRA and pay tax on it at the 24. All right, so again, Roth conversions can make sense for a lot of people. They also could not make sense. Like if we're in the highest tax bracket possible today, and we're in the 37% tax bracket, and you feel like, you know what, maybe you actually might go to a lower bracket for you in the future. Like maybe one spouse is working right now, and you're making too much money. Now, here's a little scenario here. If you're in the 37% tax bracket, but even after your spouse retires, you're still going to be in the 37% tax bracket because of the RMD and other earnings that you might have. And then if your kids, all right, are going to make good money today, and they're also in the 37% tax bracket because they make really good money and they're high-end professionals, doctor, lawyer, whatever it may be. Well, and now, you know, maybe it does make sense to convert money because at 37% here or 37% later, that's if tax rates don't change. And if you think tax rates might go up in the future, it might make sense to pay tax at 37%. This way, any future money, like let's say we have $3 million in IRA accounts today, would it make sense to pay tax on that $3 million now at 37% and have it grow tax-free in the future? Or have this $3 million grow to $6 million down the road and pay 37% on $6 million? Probably makes more sense to pay on the 3. Right? So again, every scenario is a little different, but do Roth conversions make sense? Yes, they can. It depends who you want to benefit though. If you want to benefit your lifetime, then typically by converting this money, eventually it has to put us in a lower tax bracket in your lifetime, right, in the future. If it's for the kids, there's a different parameter to look at there. So if we want to give this money more tax efficiently down to beneficiaries, like grandkids or kids, there's different ways to look at it that could be beneficial on that end. All right, but again, depends what your goals are and what you're trying to achieve. All right, so that's the first option, folks. Right, we can do Roth conversions, and for your lifetime, typically this is the best option, because what happens here with the conversions, we have this zero tax roadmap that we talk about, but are essentially, a lot of people, their goal is to get into the 0% tax bracket, and if you convert enough money to Roth, eventually you'll get to the 0% bracket. And if you're in the 0% bracket, then potentially your Social Security could have the lowest tax on it, 0%. Your capital gains and brokerage accounts you have will be at 0%. And then your Medicare premium, right, will be the lowest possible as well because your income is not going above IRMA. So a couple of things that you can look at here, right? So conversions typically help you most in your lifetime, right, if it makes sense. Yeah. Now these other options are kind of more for beneficiaries, essentially. So bear that in mind. But it could help you too. And this next one, and again, folks, not saying you should go ahead and do this, but the next one here, we can look at what are some ways that we can maybe help avoid paying too much taxes down the line, and maybe one way we can utilize that. And don't kill me in the comments here, but you actually can use life insurance. And life insurance can have a little negative connotation to it, all right, because people don't use it in the right way. But for a lot of people who have, and I would say, $2 million and up in their IRA accounts, all right, or retirement accounts, you're in this large IRA category, a life insurance account could make sense here. And here's why. Here's situationally where you could use it. If you have an RMD and you aren't using the RMD, like you don't need this money, and the RMD is coming out, you're paying taxes on it, one thought process here is if the whole point of your IRA money is they give it to your kids, right? Like you're not going to use it, it's going to go to the beneficiaries. Well, instead of just giving them an IRA account where now they're going to pay a bunch of taxes on it over a 10-year time period, that's how that works, okay? 10 years, they have to pay all the taxes on that account. Now with a Roth, which we talked about earlier, they can keep it in there for 10 years and grow it tax-free. But maybe we're in a high tax bracket today and we don't want to do a Roth conversion because you're going to pay more taxes in your lifetime. Well, you could do instead is you buy a life insurance policy with the RMDs. And why would you do that? Well, if you look at this, they're kind of trading $1 for $2 or $3. Meaning, whatever you pay for the life insurance, and let's say someone puts in like $30,000 a year into a life insurance policy, right? Their RMD just goes right into it. Well, that $30,000 a year, they pay into it for, let's say about 20 years you pay into this policy. Well, now, right, you're going to pay $600,000 in premiums over the next 20 years, but the death benefit on that policy, and again, it depends on your health and everything here, could be equal to around $2 million. All right, even if it was half that, even if it was $1 million policy, like we're not in the greatest health today, you turn $600K into $1 million tax-free, right? It is tax-free. Now, typically you get more than $1 million if you put $30K a year, and I think $2 million is probably the more likely option. Where now that's tax-free money, which then could be used to help pay the tax on the remaining IRA down the line. And on top of that, normally a policy like this, because you wouldn't just do a term, because the term expires eventually. You do some sort of like whole life or a VUL or an IUL, right? They're all out there. And this is where it actually starts making sense to use these. So for some people, right, it doesn't make sense to use most products, but if you're not use this insurance to protect against a tax situation when you pass away, right? You could use those, and then all of a sudden, right, you can have a cash value that you could utilize in your lifetime if you need to, and that is technically tax-free. But more importantly, the death benefit, right, can be used to help offset the taxes down the line. And especially if you're kind of nearing the estate tax, which for those who don't know, there's the estate tax today. If you're very high net worth, meaning you might be worth over $28 million today, you'll have a 40% tax on your estate, anything above that. So a lot of people do in those scenarios, and maybe you're getting close to there, you buy life insurance to help pay that tax. Life insurance becomes much more common among people who are high net worth because it starts making a lot more sense because their dollars are earning some sort of rate of return to give them the death benefit they want down the line to help pay taxes that the beneficiaries are going to receive. So again, not saying this option's great for everybody, but if the conversions don't make sense, this could be a very good secondary option where now you could use life insurance to give you this benefit that's tax-free right? It's achieving the same thing, right? It's tax-free money that's being received. We're just going to use it to pay off the IRA tax, right, and make this IRA situation get a little bit less overall. So that's the second way, all right? I'm going to do this kind of quick. Look at our channel for more information if you guys want to see that. Subscribe if you haven't already. But this last option, this is unique. I don't think many people talk about this in this way. And what you can do, this third option, you could do a testamentary, all right, Charitable Remainder Trust, or a CRUT, okay? Now what is that? It's a trust, all right? And of this, 10% of the money is going to go to charity. FYI. So if you're charitable or not charitable, technically it doesn't necessarily matter, because what this helps you do is defer your money for longer, right, in the IRA. And here's how. So before this kind of new rules came out a couple years ago, if someone inherited an IRA, they were able to keep it for their lifetime if you inherited it, and you could take it out a little bit at a time. IRS changed that rule to where now it's not your lifetime, but now it's 10 years, which could be an issue, right? Because now if we have a large IRA, they condense that down to 10 years, your tax bracket that you're in, right, it's going to go up. Follow me there? All right, so what you could do, instead of just having 10 years, all right, with this testamentary CRUT, we can extend it out to 20 years. Okay, so give you an essence of how it works. All right, you can make this before you pass away. All right, and the funding of the CRUT happens when you pass. The IRA goes into the CRUT. Now, when the IRA is in the CRUT, you still have to take the IRA out over 10 years. And it's going to be taxed ordinary income when you take it out of the CRUT, but you don't have to take it out of the CRUT right away. Whatever happens inside the CRUT, it's tax deferred. And with a CRUT, you have to take that money out over a 20-year timeline. That's determined by the IRS, right? And we're taking pretty big chunks out of here. Normally it's around like 10, 11% we're able to take out, right, over the balance of the account. So as that happens here, right, most as much like $2 million goes in here. As an example, it's all in an IRA. So that goes into this CRUT. We can now not pay taxes, right, on those distributions initially. Now technically, we are every year take money out. Whatever comes out of here is going to get taxed at ordinary income if it's coming out of that IRA portion. So for like the first 10 years, you'll get paid ordinary income tax, right, on this money. Now here's the beauty of this though. We don't have to end here. It can grow another 10 years tax deferred inside the CRUT. Okay, and this is where kind of magic happens here. Because now once this money gets out of the IRA, now when it's growing, you're going to pay capital gain rates, not ordinary income rates at that point in time. So if, again, 37% tax bracket, like you're in that bracket there, your kids are, now the capital gains rate, you could be at the max, the 20. And for some cases, you might even get to the 15. Okay. So tax rates get reduced dramatically because of this happening. And also, now we can invest in this CRUT, I didn't really mention, but you can invest, right, in the stock market and all this stuff here. So money's compounding inside of there, tax deferred. So you're keeping more of your money and growing on a tax deferred basis. And again, this is for the beneficiary in the account. You can do it for your lifetime too, technically, but for the IRA, it wouldn't make sense. It's more when your kids inherit this, the CRUT is when it gets formed. So with all this happening here now, we can have an extra 10 years of deferment of our money, which means more money will grow, compound more, and therefore your kids will get more money in the long run, even though they're paying taxes on it still, not avoiding the tax, but we are prolonging the disbursement of this money so that your kids will receive more, right, while paying less taxes on that end as well. So kind of unique. No one really talks about IRAs and CRUTs being combined. Normally think CRUTs is more for like a business sale or a sale of an individual stock, or you're a big capital gain that you have, and that definitely can be used for that, but the IRAs can be used for it too. And it can be very unique, and if you have a very large IRA today, it's something definitely you might want to think about. So hopefully you enjoyed this. Definitely like the video. If it was useful for you, subscribe to our channel below. We'll have more information on some other tax stuff every week. We're listing videos out here. So definitely follow our channel and follow along. If you want any help or want to talk to us one-on-one, talk to us below in the comments. We'll get in contact with you. Thanks.